Welcome back to What's Hot and What's Not CRE, your daily pulse on commercial real estate in America. Last week, we made the case for Class B workforce housing, and the feedback was incredible. Today, we're going a step further, digging a little deeper into the risk-reward spectrum. We're talking about Class C. Is there hidden value in these older, more affordable properties? Or is it a classic value trap? Let's break it down. All right, let's start with what's hot. First and foremost, demand driven by the affordability crisis. Here's the stark reality, and it's a number worth remembering. Nearly 50% of American renters are officially cost-burdened. That means they spend more than 30% of their income just on housing. Class C properties offer the most affordable rents in any given market. For millions of working families, teachers, and service workers, it's not just an option, it's often the only option. This fundamental demand isn't a fleeting trend. It's a long-term reality of our housing market. Second, the numbers can look very good on paper. Let's talk cap rates. They are attractive. We're consistently seeing Class C cap rates running 100 to 150 basis points higher than their Class B counterparts. In some secondary markets, it's not unheard of to see 7, even 8% going in yields. For investors who have the expertise to manage the asset correctly, the initial cash-on-cash returns can be incredibly compelling. Third on the hot list is the value-add potential. This is where the real operators shine. Strategic renovations can absolutely reposition a tired Class C asset into a solid Class B-. I'm not talking about luxury finishes. I'm talking about focusing on the essentials: safety, security, curb appeal, and clean, functional unit interiors. New lighting, fresh paint, secure locks, maybe some basic landscaping. The ROI on this kind of targeted CapEx can exceed 20% in the right markets, with the right execution. And finally, what's hot is who's not buying. You see far less institutional competition. The big funds, the REITs, they largely avoid Class C. Why? Well, it often doesn't fit their ESG mandates, and frankly, it's just too operationally complex for their streamlined models. For smaller, experienced local operators, this is a huge advantage. It means less competition and more negotiating leverage. Okay, that all sounds pretty good, right? So let's flip the coin and talk about what's not hot, because the risks are significant. Number 1, and this is the big one. The operational intensity is real. This is not passive investing. Class C requires constant, hands-on management. You're dealing with higher tenant turnover, a greater volume of maintenance requests, more significant collections challenges, and unfortunately, sometimes higher crime in the surrounding area. If you're not an experienced operator with boots on the ground, or you don't have a rock-solid property manager, I'd say stay away. Second, there's a definite rent growth ceiling. You can renovate a Class C property and make it a much nicer place to live, but you have to remember your tenant base. They are, by definition, price sensitive. You can't just push rents to Class B levels because you put in new flooring. There is a hard ceiling on what the local market and your tenants can bear. Underwriting aggressive, hockey stick rent growth is a recipe for disaster. Next up, financing is harder. Plain and simple. Many traditional lenders just won't touch Class C assets, especially older ones. Agency debt from Fannie and Freddie can be an option, but they have their own strict requirements. This often means you're limited to local banks, credit unions, or more expensive private capital, which will eat into your returns. Number 4 is regulatory and political risk. This is a growing concern. Rent control measures, new tenant protection laws, and aggressive code enforcement disproportionately target older, affordable housing. One bad city inspection, one new ordinance, or one litigious tenant can completely blow up your pro forma. And finally, let's talk deferred maintenance surprises. A 50-year-old building has 50-year-old problems. These properties can hide decades of neglect: galvanized plumbing, old electrical panels, failing roofs. The capital expenditure surprises can be significant and swift. Your due diligence has to be absolutely meticulous. So the takeaway on Class C: it's not for everyone. The yields look attractive, but the operational and regulatory risks are very real. If you're an experienced operator with deep local expertise and a strong property management team, there's absolutely value to be found. But if you're a passive investor looking for mailbox money, you're probably better off sticking to Class B. Thanks for tuning in to What's Hot and What's Not CRE. And don't forget to like, share, and subscribe wherever you get your podcasts. For more insights, visit hotnotcre.com to learn more and subscribe to our newsletter.